The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A busy week that could break the market momentum, or maybe it adds another log to the fire. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. A big week in terms of data, in terms of earnings, whatever you name it.
Doesn't get bigger than this.
All right, let's get to it. We have the S&P 500 losing some momentum from the rally last week in which it made record highs every day. You now have it down about 0.1%. Stocks initially rose and bonds initially fell after the U.S. announced that trade deal with Europe. You're seeing the 10-year yield not move a whole lot, up slightly to 4.41%. The dollar, though, a big winner on the day, particularly against the euro. The euro losing 1.25% here after the trade deal was announced. NYMEX crude, a big gainer here, up almost 3% on the day after President Trump's comments on Russia led to concern about an interruption of crude supply flows. Romaine?
I know we got red on the screen, Scarlett, but I do want to talk about that rally, more than 20% off of those April lows. And one of the more interesting aspects of that rally really has been the idea of it being front-run by discretionary investors and by retail traders. A buy-the-dip reallocation that is now being supported by trend-following CTA flows. With the VIX suppressed, call option volumes high, all of the elements are there for now for a continued grind higher. So that raises the question as to what exactly does trip up this rally. Well, as Scarlett alluded to, this week we do have a multitude of market-moving events crammed into just 5 days. That includes PCE data, the monthly U.S. jobs report, the first look at second quarter GDP, all sandwiched around a Fed press conference on Wednesday, a White House trade deadline on Friday, and if that's not enough, a third of the S&P 500 set to report earnings. Apple, Amazon, Microsoft, Ford, among some of those names, the most notables that are going to be reporting, and they should underscore how some of these companies are confronting tariff costs. Meanwhile, you got P&G, UPS, and Starbucks, which should give us a better read on consumer spending. And the good news in all this is that so far this earnings season, of the companies that have reported so far, more than 80% have actually beaten profit forecasts. And that, believe it or not, is on track for the best quarter, Scarlett, in about 4 years.
Yeah, but it's a new week and a new week of company earnings as well. And what those earnings will look like will go a long way towards determining whether the stock market grinds higher again. The S&P 500 here is in blue and the Europe Stock 600 index is in white. And you can see how after trailing Europe initially since late January, the inauguration, through the end of the second quarter, the S&P 500 has now caught up and is now just slightly higher than the Stock 600. Credit the S&P 500's slow melt up last week in which it made record highs every day, thanks to evidence of a resilient economy and solid earnings. Bloomberg Markets blogger Ed Harrison points out that European economic data surprises, however, have actually been better than the U.S.'s, and that maybe could signal future U.S. underperformance. Romaine?
All right, let's kick things off with Venu Krishna, head of U.S. equity strategy and global equity-linked strategies at Barclays. I mean, I don't know if you were paying attention to that chart, but when you look at that chart, does that scream American exceptionalism?
Well, it's interesting that just a couple of months ago we were debating whether the sheen of American exceptionalism is coming off. Mm-hmm. What that tells you is that it was just the sheen in question, not the core concept of American exceptionalism. And I think at the heart of it really is the performance of technology and big tech, mm-hmm. especially last quarter, which provided the fulcrum for this market to recover. And I think that's where we are, so yeah.
Do you need to see a broadening out, though, of some of the stocks that are being bought, or are we already going to start seeing that this earnings cycle?
I would say that we're already seeing some broadening. Mm-hmm. So in fact, I think just a few days ago when we looked at the underlying performance, a little under 50% of the market was outperforming the S&P on a trailing 12-month basis. Mm-hmm. So the broadening is already happening. I think the key question is, earnings are still predominantly concentrated in tech, especially big tech. Mm. And if you look at S&P outside of tech, right now, as we are in the middle of this earnings season, the revisions are running worse than long-term averages. Mm-hmm. And the question is, how do they fare against that? Now, even last quarter, when we had excellent earnings, if you dug deeper, it is the consumer-exposed segments, which is staples and discretionary, which were the pocket of weakness, mm-hmm. right? And so I think one of the things to pay attention is, do we have a upside surprise like last quarter? Mm-hmm. But also remember that last quarter we had an interesting phenomenon where companies which were able to beat their numbers didn't rally as much, but ones which missed got hurt quite badly, right? Because I guess part of it is the quality of earnings issue. If I pull down in numbers getting in and then you beat them modestly, That's not a big deal.
Investors were very quick to punish, in other words.
Right.
This broadening out, who's better positioned for that? Institutional investors or retail investors?
I would say retail. I mean, if you think the one consistent phenomenon we've identified since even the sell-off after the Liberation Day is retail has held steady in this market. Now, institutional investors, both discretionary and non-discretionary systematic money, has been increasing their allocations to the U.S., particularly the equity markets, but it's not at the same pace or scale like retail investors. But I would say to you that there's a little bit of caution is warranted because we're already seeing underlying sense of a lot of exuberance in the market. In fact, our group launched a euphoria index for equities, and that tracks within 1,000 liquid stocks with options what proportion of stocks are trading at euphoric levels. And right now, that's extremely high. So that is tracking about 12% of stocks from this liquid universe trading at those euphoric levels compared to more normal average around 6-ish%.
Yeah, wow, that's pretty sizable. So speaking of volatility and options, you look at the VIX, it's at about 15, and I know July tends to be a pretty quiet month historically for the VIX. But as Romain was saying, we have a big week coming up. We have lots of events that could change the trajectory. Do you expect to see that kind of positioning for volatility picking up as we get towards the later part of this week and into the second half of the year more?
You're right that there are enough catalysts in the immediate short term, but I don't think that is going to cause a big spike in vol. And hence, that is what drives a lot of systematic money. So systematic money, broadly, you can throw in categories like CTAs, vol control, risk parity. All of them, volatility is one of the key metrics which sort of drives their volumes. So far, it's been subdued. And in fact, to the extent that vol is subdued, they're likely to increase their exposure. If you have an unexpected shock, and clearly we're not too sure what the source could be, but if there's a significant shock, then we'll go the other way around. And a lot of the momentum you see right now can filter away. But I think the likelihood of that is relatively low at this point.
It gets to the question, though, about downside hedging, why we aren't seeing more of it. And I know there are certain pockets of the market, particularly of the options market, where you are seeing, at least on a single stock basis, on a sector basis, some degree of hedging. But the broad market hedging that you would generally expect when A, the cost of hedging is cheap, and B, when stocks are at all-time highs, is that an expression of just confidence, or is, to borrow the phrase that you used before, is that just the euphoria that we're talking about?
I think I would say partly euphoria, and partly also I would say complacency. Simply because, listen, the amount of policy-driven uncertainty we've had this year has been enormous. And to some extent, I almost feel that the market to some extent has been desensitized to those gyrations. That said, it is a fact that we are past peak tariff uncertainty, and we are also past peak geopolitical risk, right? So in such an environment, what we are also doing is looking past this year into next year. So next year, for example, in an environment in which economic growth moderates, but it's better than this year, if inflation heads in the right direction but remains somewhat sticky, and if consumption improves compared to this year but still remains less than long-term averages, in such a scenario, we still expect earnings to pick up 9%. Compared to 6% this year. So I think to some extent, how much do you want to time the market is the question. Or you just ride it. Either way, it's because things are only getting better next year rather than worse.
For a frame, we've heard quite a bit these days. Venu, great insights. Venu Krishna, head of U.S. Equity Strategy and Global Equity Linked Strategies at Barclays, kicking us off to the close here on this Monday afternoon with the big eye ahead to August 1st. President Trump's tariff deadlines. We're already starting to get some deals. A conversation coming up with Sarah Bianchi, Chief Strategist of International Political Affairs at Evercore.
Plus, Ethereum turns 10 years old. Joe Lubin, co-founder of Ethereum, will join us to discuss his outlook on the crypto market and why he thinks the world economy is being built on Ether.
And we're going to go from crypto to rate cuts. Wednesday's big Fed decision and a big Fed press conference. Vincent Reinhart over at BNY Investments going to be joining us to give us his thoughts on what to expect. All that and more coming up in a bit. This is The Close on Bloomberg.
With the U.S. clinching a trade deal with Europe and a new round of trade talks with China, uncertainty over trade is starting to ease. European Commission President Ursula von der Leyen is defending the deal, which features 15% tariffs on most of the region's exports to the U.S. And this, of course, as U.S. officials meet with their Chinese counterparts in Stockholm in the hopes of extending their truce. Let's bring in now Sarah Bianchi, Chief Strategist of International Political Affairs and Public Policy at Evercore ISI. Sarah, good to speak with you. It feels like very much 15% is the new 10% baseline that people were talking about. And Japan sets a template for our biggest trading partners, while for the ASEAN countries, we're talking about a higher rate. Are these kind of the basic parameters we're looking at now?
I think that's right. I think the EU definitely went off the Japan model. I expect that Korea will as well. I think trading partners were relieved to see the auto tariff rate come down, and the EU even snuck in a bit on semiconductors and pharmaceuticals. So I do agree the 15% does seem to be where they're headed. Of course, as you mentioned, ASEAN is higher, and even with the truce extension, if it happens with China, that number, of course, will be higher as well.
It feels, especially with the European Union, the U.S. had the upper hand, but China is its own box of surprises here, and Scott Bessent had suggested that the deadline would be extended. Does China have the U.S. have the upper hand, or does the U.S. have the upper hand here?
It's an interesting question. They're both pretty interdependent. I think China made its point, though, with some of these controls around rare earths that were really making certain United States manufacturing companies particularly nervous. At the same time, China doesn't want to see the United States ease up on its export controls on chips, which is a big relief they've provided. So in truth, it's really in everybody's interest right now to see if they can't keep the détente going a little bit. It doesn't really help anybody to get back to the numbers we were seeing last spring.
So I am curious, Sarah, overall, when you look at the trade deals, and I know this is still kind of a work in progress, when you compare the trading relationships that we are building or rebuilding now with some of these nations and regions relative to some of the deals that we were trying to work on in previous administrations, including when you were at the USTR, is there a meaningful difference in them other than the tariff levels?
Well, I mean, that is sort of the whole enchilada, right? We're going from a weighted tariff average rate that started the year at about 2.5%. Now we are north of 16%. That is a huge difference. It's going to have, we think, over time, important impacts on the economy, certainly going to generate a lot of revenue for the United States. So in that regard, it's night and day different. But some of the other issues that these countries are talking about, whether it is non-tariff barriers, agriculture, these are some of the same irritants that trading partners have had for a very, very long time. I think the biggest difference here is President Trump really likes tariff rates and tariff revenue, and so that's what we're going to have for the foreseeable future.
What does the process still look like from here? I mean, at the end of the day, we are still talking about deals that are, at least in the context of our Constitution, are still pretty much just handshake agreements that still have to be sorted out. And I am curious if investors should start to prepare for the possibility that we could see meaningful changes in some of the terms of what's been announced.
Well, again, I do think tariff uncertainty is down as we landed some of these numbers, but we saw with Brazil, right? They were at 10%, and then because of some politics, they went to go much higher. So one of the things I think that we're watching closely is these investment commitments are very, very vague. We had these purchase agreements from China in the last administration. They didn't bear out. At that time, we were in COVID and an election. But here, the administration has a few more years just to watch these. So I think as some of these things play out, we'll definitely get adjustments as we go, in addition to the fact that there are a lot of details even to still work out.
Absolutely. And it also does not appear that any of these trade deals are enforceable, in addition to the fact that there aren't a lot of details to work with here. What kind of room does that give the Trump administration to change the terms without going through a lot of process?
Well, certainly it gives them a lot of room. There's nothing magical about a 15% auto tariff compared to 25. There's no reason they're giving more relief there than they did on steel. So a lot of this stuff could change over time. Even into the night, there was some disagreements even of what had been agreed to around pharmaceutical and semiconductors. So lots of vagueness, lots of changes. I think also depending on what happens with the economy, the president himself might be looking for a bit of relief. So I think we're going to be talking about trade and tariffs as long as Donald Trump is president. But again, at least finding a landing zone is somewhere where we really haven't been. And this at least risk for high escalation. The EU, I think, is a relief because it was one of the blocks, that trading partners that was really ready to retaliate with the United States. At least some of that at this point is off the table.
Yeah, you certainly saw the relief kind of creep into markets over the weekend when you started to get the contours of that agreement. Sarah, appreciate you taking time for us. Sarah Bianchi, their former deputy U.S. trade representative and now chief strategist of international political affairs and public policy at Evercore ISI. All right, coming up here when we come back after the break, remember Paramount? Well, the FCC here in the U.S. has approved Paramount's merger with Skydance Media. We're going to talk to an analyst who covers Paramount and get his thoughts on, well, maybe he's a little concerned about what this combined company is going to look like and do once it finally seals that deal. That's coming up next here on The Close. This is Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off today with Nike. JP Morgan upgrading to overweight and raising the price target to $93 from $64. The firm seeing that the sportswear maker is going to hit a stride as its multi-year recovery plan starts to take effect. Those shares having their best day in about 4 weeks. Up next, Microsoft, Raymond James, raising its price target to $570 from $490, maintaining an outperform rating, with the analysts saying Microsoft will meet the moment when the software company reports quarterly results on Wednesday. Those shares, which have rallied for 9 straight weeks, pulling back just a touch here on the day. And finally, let's take a look at Paramount. Seaport cutting to sell, setting a price target of $11. The downgrade comes ahead of the Hollywood studios merger with Skydance Media, which the company says is expected to close by the first week of August. But the analyst is raising some questions surrounding the, quote, go-forward strategy following the close of that deal. Those are some of our top calls, and I'm pleased to say that the analyst behind that last one joins us now. David Joyce, the senior analyst over at Seaport Research Partners. And I do want to talk about this idea of what the strategy is, because I think some of us are scratching our heads, particularly in light of some of the concessions that they appear to have made in order to close the deal, including jettisoning a couple of programs that, let's face it, may not necessarily have been profitable, were certainly highly rated. What is the strategy in your view, David?
Yeah, that's really the largest question here. They talked about long-term guidance and projections more than a year ago on the pro forma combined company, and they talked about $2 billion of synergies. And in the meantime, the 3 CEO triumvirate enacted more than $500 million of synergies, but 2 out of those three CEOs are leaving Paramount. And to your point on the programming changes, if they're trying to save $2 billion, and they pointed to the Late Show with Stephen Colbert only losing $40 million, and I was a little hard to get to some of those numbers, I felt. But then they went and re-upped with South Park. Granted, it gives them a lot more streaming content for the past seasons, but they're paying about $270 million more per year on a net basis. Yeah. There's got to be a lot more areas where they need to cut. I don't know how much they're cutting into the true content creation.
Well, I'm curious on the last point, because this gets to the idea of what the strategy is and sort of what David Ellison really wanted out of this deal. I mean, when we talk about the amount of money that they gave to re-up South Park relative to, say, a daily live program like you have with The Late Show, is there an argument to be made that maybe longer term, there probably is a more profitable business in something like a South Park where the episodes can just be rerun a gazillion times over, as opposed to The Late Show, which, let's face it, kind of loses its luster after a day or two?
Yeah, there's definitely demographic trajectories that need to come into play here. South Park does skew younger than The Late Show does. Also, you need some content that's going to travel, well internationally, and there's definitely international streaming of the South Park, even though you can argue that some of the humor might be lost in some countries. But Ellison coming in is bringing a fresh perspective. I think there will be some reinvention of what Paramount is and what a media company is. They very well could collapse a lot of their cable networks and maybe just turn them into genre titles within Paramount Plus, perhaps. And if that means that they're whittling away at the content spend, that could take that could add up in some of their content savings. But I think they're definitely looking to be a content creator and looking to go globally, even further than they are now. I mean, they do have footprint there, but these details and how quickly they can get there and how they can get there with a management team we're not that familiar with is going to be a question.
It's certainly an open question. Is Paramount a buyer or seller when it comes to Paramount Plus? Is it looking to perhaps trim that down, reduce it, or buy something to buttress it?
I would think that they're going to try to be a buyer because Ellison wants to use some strategy in place. They very well could use it as a platform to then reconstruct the technological platform and the user interface, and there are some other things that possibly they could do to maybe to make it more Netflix-like. But I think that that's going to be one of the kind of the new generation media assets that will remain at Paramount going forward.
Now, you have tactically downgraded this to a sell. What would it take for you to bring it back to a neutral, David? What do you need to see?
There's a number of moving pieces. The PARA shareholders are able to tender up to half of their shares for $15 a share, so there could be some appreciation in the near term. But with some of those holders, we're just waiting for the deal to close. You could have some selling pressure thereafter, and I think that's why you might see this retrace back to the $11 kind of range. Also, if you look at how the company put the deal together, in my calculations, estimations, looks like it's about 9 times EBIT on a pro forma basis this year. But if you look at the linear exposed peers, 5 companies, they're trading at just under 8 times, and there's still a question mark on the synergies. So that 7.5 times, that would get you to $11 a share.
All right, $11 a share would bring us right back to where it was at about late April. David Joyce, thank you so much. Senior analyst at Seaport Research Partners with a downgrade on Paramount to sell. Coming up, we're going to speak with Joe Lubin, co-founder of Ethereum, ahead of the 10th anniversary of its debut, to get his take on the broader crypto market. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Scarlett Fu. And, we look at all the asset prices and how, especially when it comes to equities, they're sky high. Bitcoin feels like it's not participating, certainly today, but, it's been caught up in the euphoria that we're seeing, that so much so it's spread to other cryptocurrencies. Yeah, I mean, we saw it kind of breach 120 grand a few days ago. It's kind of been in a holding pattern since, but it's raised a lot of interest in some of the other currencies and tokens out there, but also this idea of how many companies now are adding Bitcoin or something similar to it to their balance sheets. This idea is, whether I don't know if it's an investment or a hedge or whatever, strategy. But you're seeing that obviously play out with Bitcoin, and now it's starting to trickle over into Ethereum and some of the other major tokens out there. Yeah, in addition, you have payment services like PayPal rolling out a pay with crypto feature. I don't use PayPal, but you say you do. Yeah, I use it all the time when I'm shopping online, but it's tethered to my credit card. So would you ever use a pay with crypto? For crypto, feature? No, I don't see the point. I mean, most people who are buying crypto, including myself, it's kind of a buy and hold. I mean, you're hoping for great appreciation over time. Why would I use that to buy, a sandwich or a shirt or whatever, use a things I don't need of discretionary things that I probably shouldn't be buying anyway. All right. Well, I mean, this is all part of the trend that's happening with cryptocurrency. So let's talk about the big picture of crypto with Joe Lubin. He is co-founder of Ethereum, the second biggest cryptocurrency. And Joe, I want to start with you here about this idea that Strategy, MicroStrategy, formerly known as MicroStrategy, now Strategy, has gotten so much attention for its Bitcoin corporate treasury playbook that other companies started to do the same. And now you're seeing companies do that with Ether as well, including Sharplink Gaming, which you are chairman of. What is the difference between using an Ether corporate treasury strategy versus Bitcoin?
Well, Michael Saylor's done a brilliant job with his particular implementation of the strategy. Being able to do some of the same things and many other things using Ether is actually much more powerful because Ether is a productive and yielding asset. So we've been accumulating capital in various ways every single day. We've been instantly turning it into Ether and instantly staking it or restaking it, and we'll take advantage of decentralized finance yielding capabilities. And so we're able to take our Ether and grow it directly. And we believe that we'll be able to accumulate more Ether per fully diluted share much faster than any other Ethereum-based project, or certainly faster than the Bitcoin-based projects.
And it's not just Sharplink Gaming. You've got BitMine, Immersion, BitDigital. All of these companies have been accumulating Ether in July. When you are accumulating Ether, is this something where you do it steadily as time goes on, or are there pockets of periods where you are going in to increase your holdings and other times when you're sitting back?
Well, we're doing our best to accumulate capital every single day through ATM facilities as well as using other mechanisms. We're earning yield every day on our existing Ether, and nearly every day we're buying more Ether and staking it immediately.
I am curious, Joe, about the leverage nature of this play, particularly as we've already seen, at least publicly with strategy, but with some of the newer entrants into this. How much does leverage come into play? And I am curious as to whether there is any sort of downside hedge that you have to take as a result.
Yeah, so currently we're not levered at all. We are considering offering convertibles, which will involve some leverage. And no matter what we do, we're going to keep leverage very much in check. We'll have a pretty low risk profile. We believe that decentralization is going to grow dramatically over time, and that will result in extreme appreciation of Ether and Bitcoin and some other tokens. And so the only thing that we need to do is to remain prudent with respect to risk levels.
Yeah.
And our shareholders will benefit.
I am curious as to your thoughts on the adoption of Bitcoin relative to Ether. And I understand Bitcoin obviously arrived, 5-6 years prior to Ether. We're, a couple days away from the 10-year anniversary of the first launch. I am curious as to why we didn't see a little bit more of an embrace, particularly in those first few years, relative to what we saw in Bitcoin. What was the primary difference?
Yeah, so Bitcoin's value proposition is now, it has been really clear that Bitcoin is important, similarly to how gold is important when currencies around the world are debasing. Ethereum's future has always been ahead of us, but it's becoming increasingly clear that Ethereum's future is now. As our friend Tom Lee said, the next Bitcoin is Ether and Ethereum. And what he means by that is that financial institutions and enterprises and the markets in general are recognizing that the nature of trust as embodied in these decentralized trust protocols is changing. We can bring decentralized trust to transactions, to processes, to agreements, to relationships. And by doing that, and that's especially poignant on Ethereum because you can bring programs to Ethereum and enable people to participate directly in using those programs. Every time you use Ether on this new kind of software, this trustware that is Ethereum, you're able to run processes or transactions that benefit from guaranteed execution, verifiability, the ability to set up agreements that are automatically enforceable very easily and inexpensively. And so we believe that this new kind of trust, where Ether is the highest grade trust commodity, is going to enable the economy to grow much larger and much more rapidly.
Joe, what is your confidence that the SEC under this administration has a clear digital asset policy? And I ask because, of course, we saw the SEC last week greenlight the Bitwise 10 crypto index fund conversion to an ETF, and then later on reverse course completely and say that it's putting it an indefinite stay on it.
Yeah, so I think the SEC is very clearly supportive of decentralized protocol technology. Hester Peirce has been a great advocate, very thoughtful. She may say something about certain kinds of approaches as a warning, for instance, in terms of tokenizing public equities. But that, whenever she says something, it's well thought through and makes sense. Paul Atkins has said very positive things about the direction of our technology. And so I understand that there were technicalities in those particular situations and not uncertainty really on the part of the SEC.
I am curious, Joe, about just the ecosystem, the crypto ecosystem from an industry perspective in terms of hiring, in terms of staffing levels. There's been a lot of discussion about how, despite the record run that we've seen, at least in Bitcoin and some of the other assets, despite the regulatory loosening, if you will, since Trump has taken office, that we haven't necessarily seen that translate for a lot of companies into actual profitability, into actual growth in their actually underlying businesses.
Well, I think there are some very profitable businesses in the Ethereum ecosystem. There are some very profitable protocols in the Ethereum ecosystem. The Ether token is doing quite well after languishing for a little while. And that's simply because Ethereum is currently scalable enough, affordable enough, usable enough. It's now legal to use and build on blockchain in the United States of America, where we had serious headwinds, regulatory headwinds under the previous SEC. So profitability in our ecosystem is about to be rampant.
All right, Joe, really appreciate you taking time for us. Joe Lubin there is the co-founder of Ethereum, here on the program just a couple of days before the 10-year anniversary of its launch. When we come back, we're going to talk about another launch or a potential launch. We're keeping an eye on the IPO space, and we're keeping an eye on software maker Figma, seeking to raise $1.2 billion in its widely anticipated IPO. It's our stock of the future, and it's up next right here on The Close on Bloomberg. All right. It's time now for our stock of the hour, and today we're doing something a little bit different. We're pushing towards the future. A look at the software company Figma, which is getting ready to hit the public market. It's seeking about $1.2 billion in its IPO with a newly raised price estimate of $30 to $32 a share. Bloomberg's Anthony Hughes is covering this for us, and he joins us right now around the desk. I have to say, I can't think of an IPO, a potential IPO that's been talked about more than Figma in the last few years. It seems like everybody wants a piece of this. Everybody thinks this is going to be like the crown jewel of the IPO season. Are those lofty expectations, or is that on the nose?
Well, you know, it's always dangerous to make too many predictions about the IPO market, but this definitely is a big event for the tech sector particularly. I mean, obviously we had Circle. It was a very hot IPO in June, and we've had a couple of good IPOs this year in terms of performance. But I think Figma really sets itself apart and stands out from the crowd just in terms of having being a very fast-growing software company. Software has not been a vibrant area of the IPO market since 21, when we had many software IPOs that achieved very high valuations.
Yeah.
But this will be important because this is going to be really the first time we're really seeing a premium valuation where you can think about it in different terms. But companies there's a company that's going to be commanding like a sort of mid-teens sort of maybe higher sales multiple.
And can you just clarify, because when we talk about software, this is a very specific type of software company. We're talking about a creative community, a coding community that has really embraced this stock for years, or this company, I should say.
Yeah, so this is an enterprise or subscription software company, or a software as a service company. You might not use those sort of terms, but a company that sells software which is used to design apps and websites primarily, and they have a very strong market position, and they've really disrupted the market, and particularly incumbents like Adobe, which tried to buy the company.
Yeah, I tried to buy it back in 2023 and it fell apart. And even at the top end of the price range, this listing could value Figma at $15.6 billion, which is less than what it was worth had it actually been sold to Adobe. Is it past its peak?
Well, I think we're going to find over the next few days that valuation will crystallise, and we'll see that perhaps that $20 billion number, which is the number that Adobe offered to buy the company, and it could be very well. I mean, it's hard to make predictions, but it could be exceeded when we talk about the stock trading on Thursday, because today the company upped the range, and from our reporting the IPO is 30 times, north of 30 times oversubscribed, which is a very high level of oversubscription for IPOs in recent years, not so much in the 2021 era, but the signs, you'd say, are very favourable for the valuation to improve from here.
Yeah. And just to be clear, so you expect this to price on Wednesday?
Wednesday night for trading on Thursday,
okay,
yes.
Gotcha.
Under the ticker FIG, F-I-G. All right, Anthony, thank you so much. Anthony Hughes covering the Figma IPO, long anticipated. It just adds to how busy of a week it is.
Yeah, how busy a week it is, but I think this could be a real barometer. I was serious when I said this. Everybody is talking about this IPO in a way that I did not necessarily hear about some of the other big ones that we had.
Yeah, it feels like
year.
it's going to be a benchmark one that people are looking at to determine whether things can continue on the IPO trend. All right, coming up, we're going to take you to the closing bell with Victoria Fernandez of Crossmark Global Investments. This is the close.
I think the key question is, earnings are still predominantly concentrated in tech, especially big tech. And if you look at S&P outside of tech, right now, as we are in the middle of this earnings season, the revisions are running a little worse than long-term averages. And the question is, how do they fare against that?
Venu Krishna over at Barclays, kicking us off to the close just about 50 minutes ago. A discussion here about market valuations and the idea of a market at its top.
We've been
is there
talking about
more to
this
go?
for a while.
Yeah, I know.
As long as we continue to kind of melt up, that's going to be the issue. And of course, a big tell will be the earnings that we get this week. 4 of the Mag 7 names will be reporting results starting Wednesday. What they say about their outlook, what they say about CapEx will really determine where sentiment is headed.
And I also like this part of the earnings season. We should point out something like 160 S&P companies. So you're getting a broadening of the earnings in terms of the types of companies and the types of industries. So we know the big banks held up well. We kind of expect big tech to hold up well. But what about the Starbuckses, the Procter & Gamble's, and those types of names? How are they going to do? The Fords?
We know that the weak dollar certainly has been a tailwind for them. You're not seeing that today, however. The dollar's stronger by 0.8%, which is a pretty sizable move on the back of that EU trade deal that was announced. Yeah, a big drop in the euro today. And I think this is the market now. And I think Venu was kind of getting at this idea that have we kind of gotten past the peak uncertainty and people now feel like they have some degree of clarity of what the tariff rates are going to look like, where the economic conditions are going to be. And if so, does that embolden them to take greater bets that this market can continue moving? Well, it all depends on what companies say, whether the companies feel that way or not. Absolutely here. And of course, a big part, big complexion of this rally has been the buy, the dip that we've seen over the last 8 to 12 weeks. And the big question as to whether that continues going forward. Victoria Fernandez, she joins us right now. She's the chief market strategist at Crossmark Global Investments. And Victoria, there's been a lot of talk about how when you even start, just from those April lows to where we are today, but even prior to that, this idea that every time we saw any sort of meaningful pullback in stock, people came in and filled that void. And it raised a big question about whether money was truly coming out of the market. There was a lot made about money going overseas, money going into fixed income. Did that actually play out in the data? When we look back with the benefit of hindsight, did we see a material reallocation out of U.S. equities?
Romaine, I don't think there was a material reallocation. Obviously, there was some rotation out of U.S. into some international when we saw the moves of the dollar. But really, the majority of the funds were just rotating amongst the names, amongst the sectors in the market, which is really positive for the market. And I think it's one of the reasons you saw things rebound so quickly is because those funds were there and ready to be put to work. Now, don't get me wrong, we still have a substantial amount of cash on the sidelines, but that's been there and it's waiting for its opportunity to come in, waiting for some pullbacks, maybe waiting to get through earnings season. But it's that rotation that stayed within the market that I think is one of the things, along with corporate profits that continue to do well, that are continuing to support this market.
Corporate profits so far have held up, and as some of our guests earlier today on the show have pointed out, as you look ahead deeper into this year and into 2026, there's anticipation that we'll see an acceleration in some of that profit growth. Are you in that camp?
You know, I've been really worried about corporate profits. We were having such strong year-over-year growth for multiple quarters now, 13, 14% growth in profits. And we had to think that that was going to pull back some, especially when you had tariffs coming into play. So if you have higher input prices, and look at the PMI reports, S&P Global said that we had significant moves higher in prices, both on the manufacturing and the service side. If you have those higher prices and companies are not passing them on to consumers, or they're passing them on and consumers say, we're just not willing to pay that price, you're going to have to get some margin compression. You're going to have to see those earnings come down. Perhaps we start to see that feed through into the third quarter or fourth quarter earnings season. That will be something that we'll be watching very closely, because it really is profits that have held up the labor market, that have held up the consumer.
I want to ask about CapEx and how you're going to be listening for it in earnings calls. We get 4 of the Mag 7 names reporting this week. And of course, CapEx will be top of mind for these big tech companies because they're spending they're committing tens of billions of dollars to building out their AI infrastructure. And of course, this is something the administration wants to see, a CapEx comeback on the heels of the One Big Beautiful Bill. Is it always a positive, though, when you see companies committing this much to CapEx?
Well, Scarlett, I don't know if we say it's always a positive, but it is something that this administration is looking for. It's something that tends to help us. You look historically, as CapEx grows, it means you're getting less input from the government side and you're getting more of the private sector investing money. And this is really important. It helps productivity. It helps GDP growth. So you want to see that CapEx come in. Obviously, though, so much of the CapEx right now is driven from the AI component. We saw the estimates go up with Alphabet. Everyone will be watching this week to see, you know, what we hear from Meta, from Microsoft, from Amazon. If we hear anything from Apple on what they're spending on AI, we don't know yet. We'll be watching. But we'd really like to see some of the CapEx come from the rest of the companies, too, outside of that tech sector. And that's where we need to see some growth to make it a really highly productive component in this economy.
So in addition to 4 of the Mag 7 names reporting, we've got the FOMC meeting, we've got the latest jobs report on Friday. What's the catalyst that is going to move the bond market? The equity market has been steadily making new highs, but the bond market is pretty much range bound.
It really has been range bound. And I think the bond market is looking for, one, the refunding announcement. We'll get that on Wednesday. We just got not too long ago the announcement that there's going to be a larger amount of issuance coming. We want to see where that's going to be, whether it's going to be T-bills, whether we're going to see coupon notes coming with that. I think that could drive part of the bond market. We're looking at inflation expectations. We've got core PCE coming. That could, you know, make those longer term inflation expectations start to come unanchored if that's going to be higher than what people anticipate. So there are some elements there. A weaker labor market could shift the yield curve as well if they think that's going to pressure the FOMC to lower rates even more in September and or December. So I think there's a lot of elements that could move yields, but if they all counteract each other, and there's so much out there right now, we could continue to be range bound until we actually see rate cuts come into play or until we see a significant move on inflation.
Victoria, always a pleasure. Victoria Fernandez, Chief Market Strategist with Crossmark Global Investments, counting us down to those closing bells. Just about 3 minutes to go, Scarlett. And we talk about this idea of a week that has so many catalysts involved. Obviously, the Fed in the middle of the week is going to be sort of front and center, but so much economic data around that, and obviously the earnings we were just talking about.
Yeah, we've got the first read of second quarter GDP coming out. We've also got PCE, which will be critical because of that Fed meeting. Yeah. And don't forget, the August 1st deadline for trade comes up as well.
And you've got a jobs report, too. So much stuff going on in there. And of course, we should point out that, of course, that big week of earnings actually kicks off in just a few minutes when we get the closing bells. Whirlpool, Nucor, as well as Cadence Designs, some of the names expected to report in just a few minutes' time. Right now, the market's in a bit of a holding pattern with the S&P 500 unchanged on the day, a modest bid to the NASDAQ as we break down all of today's market action right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic here with Scarlett Fu, taking you through to that closing bell with the global simulcast. Carol Massar, Tim Stenovic, they're both in the radio booth as we welcome our audiences across our Bloomberg platforms, our partnership with YouTube here on a day where the market's in a bit of a holding pattern. Carol Massar, ahead of a phenomenally busy week.
Yeah, exactly. As many people have said, what happens this week maybe determines direction for the rest of this year. We have some great reporting on the Bloomberg bar, Alex Semenova and team. But I agree, right? Big tech earnings. We've got a Fed meeting. We've got a jobs report, some other economic data. What am I leaving out? Oh, yeah, trade deals. There's a lot coming at investors this week.
Apple, Amazon, Microsoft, Meta Platforms are a few of the companies that we're watching closely, but don't forget about Procter & Gamble, Boeing, UPS, Starbucks, Visa, PayPal, Ford, and more.
And don't forget also Figma's IPO. It's going to price on Wednesday. We'll begin trading on Thursday under the ticker FIG. And it's going to be a pretty phenomenally large IPO, a long-awaited one, especially since the Adobe purchase didn't pan out.
And it gets to this idea of, like, we talk about the quality of companies coming into the public markets right now. There was some concern that we would see a lot of trash coming down the pike, but for some of the big IPOs we've had so far this year, we're talking about relatively stable companies, relatively mature companies with decent revenue, and in some cases, particularly with Figma, actual profitability.
And interesting to see IPOs continuing, right? It's been so quiet, but we continue to see them come to market, which shows a sign of confidence, no doubt about that.
As we wait the closing bells, like here in New York on this Monday afternoon, a somewhat tepid day of price action, somewhat lower volatility. But of course, the expectation is that's going to pick up in a material way over the next 3 to 4 sessions. An S&P 500 that is straddling the line right now between gains and losses. It takes a while for these numbers to settle, but based on the way they're bouncing around now, it does look like it will finish in the green, which will be a record high. The Dow Jones Industrial Average is in the red, down 60 points or so, or about 0.1%. The NASDAQ higher by about 70 points, or 0.3%. And the Russell 2000 sitting this one out, dropping about 4 points, or 0.2%.
All right, digging once again into the S&P 500, guys. Most names lower in today's session, Scarlett. About 361 losing ground here, and 141 to the upside.
All right, let's take a look at the IMAP, which shows that you do have more decliners than advancers when it comes to industry groups. In fact, 3 groups finishing in the red by more than 1%. We're talking about real estate investment trusts, materials, and utilities, all down at least 1%. On the flip side, energy stocks gaining more than 1% as oil prices track higher. Tech and consumer discretionary also in the positive.
All right, let's get to some of the individual gainers on this Monday, and definitely the semiconductor space. I'm looking at the stocks, definitely easily outperforming the broader market today. It's up about 1.6% here, so pretty much finishing at its highs of the session. And so you also had, if you look at some particular names, a lot going on in this space. AMD was also your number 2 gainer in the S&P 500. That one was up about 4%. So you did have U.S. chip makers rising as AMD. You saw UBS analysts raise their price target on AMD to 210 from 150. You had AMD today closing up about 4.3%, as I said, and closing at 173 and change. So some room to run, according to UBS. They also did maintain a buy rating on the shares. You also had Samsung Electronics producing AI semiconductors for Tesla, a new $16.5 billion pact. So a big win for that company's foundry division. So there is a lot going on in the chip space today. And you definitely saw even some European names, ASML, for example. It also gained some ground, and that is on the U.S.-EU trade deal, or at least progress, certainly, on that front. Do want to mention Tesla up about 3% in today's session. Morgan Stanley analysts forecast that the market for self-driving vehicles will hit $200 billion by 2030. So we saw Tesla up about 3%. And then Nike, I just want to mention, up about 3.9% in today's session. JP Morgan coming out, upgrading it from neutral to overweight, raising its price target from 64 to 93, and telling clients to just buy it in a new note out today.
Hey, I just want to check in on some earnings. This on Cadence Design. This is a software company. The software primarily used to design chips. The company saying that revenue in the most recent quarter came in at about $1.28 billion, a modest beat over street expectations of $1.25 billion. Adjusted EPS also beat $1.65 versus street estimates of $1.56 a share. And the company raising its 2025 revenue outlook, saying that it expects growth for the full year. Let me just make sure I have this right, of 13% here. You see the shares higher by about 6% in the after-hours trade.
Okay, that's Cadence Design. We got our eyes out for Whirlpool. We're expecting them to report in just a few minutes. In the meantime, let's take a look at some decliners in today's trade. I want to start with Open Door. And before, Romaine, you give me a hard time about choosing this one. It was the most actively traded stock today.
Yeah, I know, Tim.
Okay.
You get a pass. It's a
all right.
stock.
I got to come with, ammo to back up my choices here. 7.9% to the downside here. The company's postponing a shareholder vote on a reverse stock split after a recent run-up in the company's shares. Remember, it had scheduled this meeting due to a notification from NASDAQ that it could be delisted for failing to maintain a stock price of $1 or more. That was then. This is now. Shares are now above $2 per share. The recent volatility, though, in the company's stock price led the board to delay the vote on the stock split proposal. Still, the stock fell today, 7.9%. And Gilead shares fell as analysts noted a potential risk to the company's HIV preventative franchise after Robert F. Kennedy, the Secretary of Health and Human Services, had been reporting to plan the dismissal of an advisory panel that determines what preventative health measures insurers must cover. Shares fell 2.7% today. RFK Jr. plans to dismiss all 16 panel members of the U.S. Preventative Services Task Force because he views them as too, quote, woke, according to the Wall Street Journal, citing people familiar with the matter. And finally, Duolingo.
What? They were what?
Too woke, according to the Wall Street Journal. This is, I'm quoting the journal's reporting here. Finally, Duolingo down 6.
Did they define that?
5. They did not.
Oh, okay.
I'm sorry to say.
All right.
Moving on to Duolingo, shares down 6.5% today. Citizens out with a note that said it was cautious on the company's upcoming results. The company said third-party data suggests engagement slowed since April. The analyst Andrew Boone adds that slowing growth raises the question of whether Duolingo's total addressable market is saturated. They did lower the price target to $450 from $475. The company is reporting results for the second quarter just in a couple of weeks, August 6th. Next week, actually, August 6th.
All right, let's take a quick check in yield here. Not a whole lot of action going on there on the shorter end of the curve. Really no movement at all. But once again, you do see yields tick higher on the longer end of the curve. 3 basis points on your 20-year and your 30-year. So a steepening, Scarlett, of the yield curve.
And we just have Whirlpool results crossing. Net sales for the second quarter, $3.77 billion, missing the average analyst estimate of $3.85 billion. Second quarter ongoing EPS of $1.34, also missing the consensus estimate of $1.61. As for the outlook, Whirlpool sees full year cash from operating activities of about $850 million. It has kept its full year revenue outlook intact, about $15.8 billion. Analysts were looking for about $15.64 billion, and it sees free cash flow for the full year of $400 million, whereas previously it had seen $500 to $600 million. Tim?
Some notable commentary from Andrew Bitzer, somebody who's pretty candid. We've spoken to him quite a bit over the last few years. He's this chairman and CEO. He said, as expected, the second quarter continued to be impacted by competitors stockpiling Asian imports into the U.S. Despite this, we're well positioned in North America with a robust pipeline of new products, the industry's leading U.S. manufacturing footprint, and favorable housing demand fundamentals. He says they're confident in the long-term strategy, and he says that evolving tariff policies will ultimately support domestic manufacturers. A reminder that their U.S.-bound products are made here in the United States, the majority of them.
And you do wonder about some pull forward, maybe still impacting some of these companies in terms of competition. I also will draw your attention to a story that's among the most read on the Bloomberg about the U.S. housing market posting their worst spring selling season in 13 years. So if people aren't buying new homes, finding new homes, not buying new appliances, like all of this certainly has an impact.
Yeah, and we've talked about this a lot here. I mean, this is more a business that is probably less affected by tariffs and more by just the general cycles that we're seeing in the housing market, which, of course, to some extent are also tied to economic conditions and, of course, tariffs. I do also want to point out, too, I know you guys have talked to him a lot, and I know they like to tout the idea of most of their stuff being made here in the U.S., at least the stuff they sell here. But there's still a lot of components that go into that that does have tariff exposure. Not quite sure how they quantify that, but definitely something that you have to keep in mind.
What about the materials that they use, like the raw materials?
Oh, yeah.
And that are being tariffed right now.
Absolutely. Yeah.
Yeah, this idea of being confident in their long-term strategy, but the evolving tariff policies really leaves them without a lot of control in a lot of situations. They kind of have to passively take it in and adjust as needed.
Sounds like a lot of questions for them on the upcoming call with analysts and investors. Stock still down about 6.2%. We're talking about Whirlpool. All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Scarlett and Romain continuing there on TV, and Tim and myself continuing right here on Bloomberg Business Week Daily. We'll see you all again tomorrow.
And our coverage continues here on Bloomberg Television with a look at, well, how to trade the fixed income markets. U.S. corporate credit spreads hitting their tightest levels in 2 decades. We're going to get some thoughts out of David Forgash over at Pimco when we come back after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. Romain Bostic here with an S&P 500 squeaking out its 15th record high of the year. Calling it a gain or calling it a rally, at least on the day, is probably generous, but this grind higher has been a big hallmark of the rally that we've seen off of those April lows. The energy sector was out in front here on the day. Not as much activity when it came to the tech space as well as the discretionary space, but that could change in a big way over the next couple of days. And then keep an eye on the dollar, the euro, having one of its biggest drops relative to the dollar in a couple of months. Gold also taking a leg down, and this is largely on optimism, at least here on the U.S. side, when it comes to those trade deals or trade agreements that the president has been touting. As far as some of the individual movers, Albemarle and the other lithium stocks taking a huge leg down on the day. But then you take a look at a name like MongoDB. Mid-cap software company, one of the biggest laggards in the software space this year. It is on a phenomenal run now, 10 straight days, including 1% on the day. Supermicro, Tesla, rounding out some of the big moves that we've seen in some of the stocks that, well, I guess can generously be called somewhat maybe questionably valued. So as the S&P extends to its 15th record high of the year, the discussions about market froth in public equity markets has been bubbling up. But there's a big question right now about debt and about private markets. Is that frothy too? That is our top story this hour. You have a junk bond market that is red hot, a leveraged loan desk across the Wall Street that have been as busy as ever, and ETFs offering collateral loan obligations that are flush with cash. It's no secret that the riskier parts of fixed income typically have high correlations to equity indexes. In fact, as the S&P has rallied 26% over the past 16 weeks, the Bloomberg U.S. Corporate High Yield Index has rallied in 13 of those 16 weeks. And that has pushed the spread on high yield bonds relative to investment grade back down to around 200 basis points. And when you divide that spread by the amount of leverage borrowers have taken on that premium to buy the riskiest corporate debt over the safest is at its narrowest in at least a decade. Our next guest potentially sees some risk in that pricing, but also maybe potentially some opportunity. David Forgash is Managing Director and Portfolio Manager at Pimco, and he joins us right now. And David, when you look at how tight spreads are, particularly relative to the high yield part of the market and the more safer parts of the market, if you will, what is that telling us?
Well, it tells you that there's a lot of interest in the product, obviously. There's a reason why spreads are very narrow. We've had some very good earnings out of companies across the board. There's a lot of the concerns that were in the market previously over the past few months as far as tariffs, trade, things like that, that now we're getting a much better grip on, much better certainty. So you're right. There's no way to argue against the idea that spreads are at their narrowest in almost 20 years. But if I take a look at the quality of the high yield market, it's also at its highest quality in about 20 years. So there are reasons behind why there's such narrow spreads. Doesn't make us any more desirable, though. I mean, we would still prefer to have wider spreads. But looking at all in yields, that's where you're getting the attractive part of it.
Well, when you talk about the quality, I mean, how much of that is linked to some of what's been going on with regards to tariffs and all the uncertainty around it, and the idea that at least the worst case scenarios for a lot of investors appears to be off the table. Yeah, there'll be higher tariffs, but overall, we haven't seen a huge amount of economic damage, at least not here in the United States, and most people don't expect that. Is that a big part of the quality thesis right now when it comes to those names?
Yeah, well, it's part of the quality thesis. It's part of the reason why you have such narrow spreads, the idea of defaults being quite remote for many of these companies. Now, that doesn't mean that they're not going to be there, but default rates have been extremely low over the past year. They're just above 1.5% at this point, which is a very low number compared to a 3% average for the past 25 years. So if you take away some of those concerns for default, which is a big component of what you receive that spread for, well, that points to the idea of a narrowing spread component. And then if you also, as you were just saying, look at the questions that were in the market before about tariffs and trade, you take some of those away and you have a very strong underlying momentum to the market. It doesn't mean that we're not getting too frothy. I mean, we are probably priced a bit to perfection, We do think we're probably in the shift now where you could see a better opportunity for to invest at wider spreads, and we consistently look for those opportunities. So that's why you have to keep a portfolio, as we have right now, more up in quality, meaning more in the double B part of the space, less of triple C. If you do that, then when the market does widen out, you've got better opportunities to get some of these credits that you wish you could have had at wider spreads.
How global does your portfolio look right now in terms of allocation, David?
Yeah, so we always have to keep a global eye out. So when we invest, we do it globally. Big team over in Europe as well as in the United States and in Asia. But where you find is opportunities for standout characteristics like you have right now in Germany. So there's U.S. exceptionalism, but there's also European exceptionalism in the form of Germany, where they've been putting much more into their manufacturing base, much more into infrastructure, some of it going to defense, but other areas as well. Those are areas where we invest in, and we're seeing good opportunities for outperformance. They're also being helped over there by a weakening dollar, so they're structurally able to support themselves better with a stronger euro from that perspective.
Is the base case right now for you and your team over there at Pimco for the dollar to remain weak, relatively speaking?
I mean, we're not calling for a big move further in the dollar versus the euro. I think when you invest in a portfolio like this, you're investing in European credits, you're investing in U.S. credits. You have to think from a perspective of the companies where most of their revenue is coming from. A lot of these companies are based in US dollar revenues, even in some of the European companies. But there's a huge diversity of them out there. So when we put a portfolio together, you have to do one that has the ability to withstand movements in the euro strengthening or the dollar strengthening or any of the other currencies we invest in. And you can do that with a broadly diversified portfolio, especially when you do one that's globally diversified.
I have to ask you about this idea of how healthy markets are right now. And I mean that more from the idea of feeling confident about, price discovery and transparency and things like that, and liquidity for that matter as well. How does that stack up right now?
I mean, I have to tell you, the liquidity in the high yield market is as strong as it's ever been. And that's not just a mere point in time. That is due to some structural changes that have taken place over the past few years. In other words, more electronification of trading through portfolio trades. These have started several years ago, but the amount that they're used on a daily basis is tremendous. You can move huge blocks of high yield bonds or loans in these types of portfolio trades. Mostly we do it in high yield bonds, but you could do them because the ETFs that have grown in popularity and taken a large share now of high yield debt, they're investing in high yield bonds, and then when they come in to do either increase the size of their ETF or decrease it, well, they do that through what's usually a portfolio trade with a dealer. And on the other side of that, you've got investors like Pimco that will use that liquidity to change around our portfolio, add to the credits we like, change some of the credit positioning. It's added a lot of liquidity to the market.
All right, David, great stuff. David Forgash, Managing Director and Portfolio Manager over at Pimco. A look at what's going on in debt markets and in private markets. We return to public equities, though, with tons of earnings on tap this week, including more than 30 S&P companies set to report tomorrow. And that includes UPS. We're going to discuss what to expect with Jason Seidl over at TD Cowen. That's coming up next here on The Close. This is Bloomberg. Earnings season is heating up. UPS set to report results tomorrow, with the parcel carrier expected to show a decline in domestic revenue again, with investors looking for an updated full-year financial outlook. This after it decided not to provide one last earnings season. Jason Seidl joins us right now. He's an analyst and managing director over at TD Cowen. So, Jason, I just take a look at the overall revenue numbers. $21 billion is the expectation on average, $1.56 on the EPS side. But, of course, both of these numbers would be a decline from where we were 12 months ago. What's going on?
Look, it's a soft market right now. Their main competitor, FedEx, reported back in June, and recall they were projecting for a soft domestic B2B market on that call. And so I think if you look at the consensus expectations, particularly for the back half of the year, it's already below their prior guide for UPS. So I think the street is already there. It's going to be interesting, the commentary out of UPS on the economic backdrop.
Well, I am curious. I mean, it's going to sound like a dumb question, but how tethered are they to that economic backdrop, Jason?
No, I think it's a lot. Like my entire universe, whether it's air freight, logistics, rails or trucks, my guys really can't escape that economic reality. But there are some things that I think are headed in the right direction for the company. We're expecting actually some decent pricing commentary. We do an intra-quarter check-in with AFS Logistics, and we do a predictive rate index for both trucking, intermodal, as well as parcel. And that's showing that things are starting to tick up. Both FedEx and UPS are actually getting a little bit more aggressive about flexing accessorials and fuel surcharges.
And on that point, though, too, it gets to this idea that, when they last reported earnings, there was this massive cloud of uncertainty hanging over our economy and the global economy, whether it was the issues going on with tariffs or the budget bill and things like that. A couple of those things have been resolved, certainly with the budget bill, and it looks like we are making some progress on trade deals. Yes, there will be tariffs. Yes, they will be higher than where they were at the end of the year, but at least we have some clarity as to what they will be. Do you think that would be enough to embolden management to provide and guide maybe a little bit stronger than what they would have in the absence of those deals?
I'm not so sure we're quite there yet. I still think there's a decent amount of uncertainty in the environment. What we've seen so far from transportation earnings is, a decent quarter and sort of a cautious outlook. Most people aren't trying to predict beyond 3Q because it's still fairly difficult. There also is a little bit of uncertainty about just how much was pulled forward because of these tariffs. Now, even the Port of LA, the head of the Port of LA was on recently, and he was saying that, hey, look, July is strong, but we're expecting a decent fall off in August and September. So I don't think they're going to go really strong beyond maybe even telling us how 3Q looks.
But you're of the mindset that even if on the revenue side, or I should say with regards to the volume side, things might be a little constrained, you do think they have maybe some degree of pricing power to maybe make up for that?
Yeah, I think there's going to be a little bit of pricing power. And look, UPS has been pretty aggressive about taking down a lot of its costs. Both them and FedEx are actually shrinking their networks to sort of right-size things. And then UPS has gone back to their rank and file members and looked for a buyout from some certain drivers. And we'll see how that goes. It looks like early indications are that the Teamsters aren't too happy about the initial offer.
So when we get to that conference call and we actually have to hear her really kind of articulate the longer term vision, I'm talking beyond just the next couple of quarters here. I mean, she's been there for quite some time. She's had a chance to really put her stamp on this. I was always under the impression that investors in the analyst community were relatively happy with the direction that management had taken this company. Do you think that continues?
Look, I think that as long as they continue to provide us that roadmap to taking those structural costs out of this network, I think that's what's needed for UPS going forward. And then if we can just get a little bit of help from the economic backdrop, then things can start taking off a little bit. No pun intended.
No pun intended. But well, let's actually play that pun, though, too, because it gets to the idea of whether there is growth or I guess some transformation for this company beyond what they do. I know they've scaled back a bit, but do you see the potential for a reset where they start looking more at international markets? They start looking at more other modes of delivery that maybe aren't a core part of their business?
I think that's a little bit out in the future for them right now, at least in terms of most investors' time horizons. But if you look at what they're doing now, again, they have to right-size their network. They got out of the business, or at least half of the business that they have with Amazon, that really wasn't providing them the returns. Now, I think they were a little bit late in figuring that out. FedEx was a little bit earlier to the game. But look, I give the management team credit for actually getting there.
Jason, really appreciate you taking time for us. I know you got a busy morning ahead of you. Jason Seidl is analyst and managing director over at TD Cowen. A preview of those earnings out of UPS, which are scheduled to cross the wire tomorrow morning. Team Surveillance will be all over that. A slew of companies set to report tomorrow as well, both before the market and after. When we come back after the break, here in now on The Close, we're going to talk chocolate. It's a bit of a dark time for the industry, with producers bitter about rising cocoa costs. We're going to talk to the president and founder of Hotel Chocolat, Angus Thirlwell. As concerns swirl around consumers cutting back, well, his company is expanding. That conversation coming up after the break. This is The Close on Bloomberg. All right, chocolate producers, they're feeling the heat of rising cocoa costs. Nestle, Hershey, Lindt, all hiking prices in the first half of the year, with Lindt CEO warning of another year of cocoa inflation. but a company called Hotel Chocolat, which Mars acquired last year, is going full steam ahead with its U.S. rollout, opening its first brick and mortar stores here in the U.S., including in Chicago. Joining us live here in New York is the founder and president of Hotel Chocolat, Angus Thirlwell. Great to see you, Angus.
Thank you very much. Great to be here.
You know, it's funny, when we were booking you for this show, I just happened to be in Chicago, and I just, by complete happenstance, happened to stumble on one of your stores. I think it's 2 stores that you have in Chicago, and these are relatively new. I mean, Hotel Chocolat has had a presence overseas for quite some time, not necessarily so in the United States. Was the Mars deal what facilitated that rollout, or was that already in the works?
Certainly, partnering up with Mars has unlocked it for us. I've had a personal, long-held ambition for our brand to win in America and to bring everything that our brand stands for to the American consumer. And in Chicago, we've had an amazing set of results from the first 2 stores, 3 more to open in Chicago before the end of the year. And yeah, we've got, you know, the wind in our sails and can see very clearly the gap in the market.
With regards to your retail strategy, and we should just point out, I mean, this isn't like you just walk in and you just buy a box of chocolate. I mean, there's, you know, the drinks and the chocolate wall and all this other stuff you have to choose from. It's an experience. Are all the stores sort of structured that way?
Yeah, the intention is that we make our physical stores do a particular job for our brand, and the job is connecting with the community and showcasing the drinkable side of chocolate. When you know, when people think about chocolate, they immediately go to a chocolate bar and something that can be, you know, snapped. The drinkable side has got a much richer history. It goes back 5,000 years, whereas the snappable chocolate is only 250 years. And what we're doing is bringing a new take on drinkable chocolate. And that's one of the reasons why we're able to grow in such a strong way. It's really working for us. It's working for the customer.
How do you manage your costs? I mean, it seemed almost audacious to even start a business like this, and to be able to grow it to the revenue level that it's at right now. Are you sort of hedging yourself against big fluctuations that we have in commodity prices, particularly with sugar, cocoa, I assume eggs, milk, other things that have just skyrocketed over the last few years?
Yeah, very much. I mean, one of the benefits of me running the business for 20 years is that I've seen it all. I remember when hazelnuts spiked and almonds spiked, and similarly with milk and you know, energy in the UK as well went completely bonkers for a while. And the thing that we've always held on to is a long-termist approach. And we've you know, not been knocked off our stride by things which, when you analyze them, are short-term pain points. And when you have the luxury of a long-termist ambition and view, you have to take them in your stride. And that's what we've always done. We've never compromised on quality. Our customers have told us again and again, never change the recipes, never tinker with them. We'll pay whatever it takes to get our Hotel Chocolat.
Now, with regards to the sourcing, though, I mean, the beans that you're using in the chocolate, are those grown primarily on properties that you own, or are you buying them from third parties?
We have a bit of both. So our own farm in the Caribbean, in St. Lucia, which we run end to end, and is a proud Caribbean business that employs virtually all local talent from St. Lucia and pays taxes in St. Lucia, works, but it only represents 5% of the cacao that our business needs to operate. Even though we've improved the yield and got the whole cacao industry working again on this small island, we need more. So Ghana is our main source. And we've been able to take all the learnings that we've acquired ourselves from 15 years of tilling the soil and harvesting beans to be a really good partner in Ghana with farming families. So we know what the issues are, and progressively over the next few decades, we'll be able to make it work even better.
I am curious about the structure of the business under the Mars umbrella. You're still more or less operating as an independent company, but of course you have the heft of the Mars brand, the Mars ecosystem behind you. But there's always been concern at some points in time where we've seen these sort of companies, whether it's like Ben & Jerry's being bought by Unilever, some of these other small kind of companies that get big and then they end up inside these conglomerates. Why do you think that's going to work for Hotel Chocolat?
Yeah, I mean, this is my life's work in terms of my business career, and I wasn't going to take any chances. Hotel Chocolat has been approached by virtually everybody you could ever think of who's, you know, kind of big and powerful in this world. And the conversations did not go very far because I could not imagine our brand flourishing in that ecosystem. When I had the conversation with Mars, it was very different. And I did the due diligence very carefully. We're now 18 months in, and I'm really seeing the benefits come through. I'm personally enjoying it. And I believe in the power of collaboration, which is effectively what we're talking about here. And we can only make our ambitions come true by scaling, and that means impact in cacao agriculture as much as shaping the way that consumers think about chocolate.
Yeah.
So we've got a big job to do here, and as my wife pointed out, I've only got, you know, maybe a couple more decades of being top of my game left, so I better get a move on. So hence, you know, the collaboration with Mars makes total sense. We have a meeting of minds on what's important in the world, tons of long-term bravery and courage to back beliefs, and that's exhilarating.
What does demand look like overall for the chocolate? I know there's been some talk about maybe people aren't eating or consuming as much chocolate as they did in the past. I mean, what does that long-term trend look like? What are people eating?
Well, I think there's obviously a world of candy and confectionery, which is different part of the market from chocolate. What we like our consumers to do is actually be very conscious and actually to not eat too much chocolate. It should be something that's reserved for day parts and should be consumed consciously, and that's very much our mantra of more cacao, less sugar. It's all about balance, and we don't think it's a bad thing, frankly. And if everybody approached consuming food in a more conscious way, then we'd have a better planet.
All right, well, it's a nice balance, and really wishing you all the best.
Thank you very much.
Angus Thirlwell there, he's the founder and president of Hotel Chocolat. All right, let's take a look at some of the movers that we're seeing here in the after-hours trade. We've had a flurry of earnings cross the wire, including from Cadence Design Systems, a raise in its guidance, and a pretty decent beat for the most recent quarter. And you see those shares on the second line of your screen, up 8% in the after-hours trade. Universal Health Services also getting a modest bid in the after-hours trade after net revenue came in line with estimates, but the company gave guidance of about $17 to $17.3 billion that comes in ahead of estimates. The two down names there are to keep an eye on. Whirlpool still being affected by tariffs and still being affected by economic conditions. And Nucor, this is the steel company, down about 4% here in the after-hours trade. Net sales coming in line with estimates, EPS coming in line with estimates, but the company saying that it expects 3Q earnings to be nominally lower than in the second quarter. This is the close on Bloomberg. All right, let's take a look back at this day in history. July 28th, 1977, 11:02 p.m., if you want to be precise. That's when oil pumped from Prudhoe Bay on the north slope of Alaska completed an 800-mile journey through a new pipeline connecting export terminals on the state's southern coast. It was a slow journey that took 38 days, but one that would transform the U.S. oil sector over the next 48 years. Prudhoe Bay was the largest oil field in North America, but the ice caps over the Arctic, it prevented container ship access. The federal government considered several options. One idea, massive 12-engine Boeing aircraft to transport the oil. Another involved submarines from General Dynamics that could travel beneath the ice cap. Now, ultimately, the more practical solution was just build an above-ground pipeline. The project, it officially started in 1969, relying, ironically, on imported Japanese steel pipe because U.S. manufacturers didn't have the capacity. The project accelerated after the 1973 OPEC embargo, prompting Congress to remove all legal barriers from construction of the pipeline. The Trans-Alaska Pipeline opened in 1977 and at its peak in 1988 would funnel 2.1 million barrels a day, or about 25% of all U.S. oil production. Exports of crude exploded from around 1 to 5 million barrels per year in the early 70s to consistently above 50 million by the 1980s. That led to an economic boom for the state of Alaska, which saw its population swell by 50% in a decade and personal incomes quintuple over 2 decades. And now, 48 years later, is deja vu all over again. The massive oil industry on the north slope of Alaska produces a massive byproduct, natural gas. But since the pipeline was built to only accommodate oil, that natural gas has basically been trapped. 35 trillion cubic feet of proven reserves, almost as much natural gas as the U.S. produced as a whole all year long. The most prominent idea to get it out of there? A $44 billion project to build a dedicated pipeline that traces a similar route as the Trans-Alaskan one did when its spigots were first turned on 48 years ago. And of course, natural gas has been in the news a lot lately, particularly when it comes to the trade deals that the President of the United States says that he has struck with Japan and, of course, with EU. The EU pledging to buy $750 billion of U.S. energy imports over the next 3 years. That's a meaningful jump from current levels, but it raises questions about whether the EU can actually make good on that promise. Kailey Leinz is the co-host of Bloomberg's Balance of Power. And Kailey, that really is the question right now. I guess we have a deal, a handshake agreement, if you will. Now, the big question is, what's the follow-through?
Well, exactly, Romaine. As we think about energy in particular, that is about $250 billion worth of European purchases of U.S. natural gas, oil, nuclear technology each year. And to put it into context, last year, Europe only purchased about $80 billion worth of energy from us. So there is a huge question as to whether or not they can actually escalate things that quickly. But there's also a question on the supply side of whether the U.S. is even able to provide that much for sale, keeping in mind that our total energy exports in 2024 were about $330 billion. So that's not much beyond that $250 billion level. All of that said, making that commitment to the U.S. and to President Trump specifically is part of what Europe had to do in order to secure this 15% tariff rate that is applicable not just to most of its exports to the U.S., but to key sectors that have Section 232 investigations ongoing, like semiconductors and pharmaceuticals. Even when those investigations conclude, expected a few weeks from now, which may mean other countries face higher tariffs on those products, Europe has secured this 15% rate. Not just energy purchases agreements were part of getting the U.S. to essentially agree to that 15% rate, but also $600 billion worth of investments into the United States, as well as what President Trump has described as vast purchases of U.S. military equipment. All of this, of course, before the Friday deadline where Europe was set to face a 30% tariff being implemented on August 1st. Romaine.
Yeah, and we should point out, of course, these are preliminary agreements and still a lot of work has to be done on it. But at least as of right now, you can check off the box of the EU, massive economy, check off the box of Japan. China, Kailey, I know that U.S. officials are over in Sweden now, apparently having talks. Is there any progress at all on potentially checking off that box?
Well, neither side, Romaine, spoke to reporters upon leaving the first day of talks in Stockholm. A second day is scheduled to resume tomorrow morning, where we may get more information. But essentially, this is the third round of talks we have seen in as many months, following up on the original talks from Geneva and London, where, of course, in London, they re-agreed to the framework they agreed to. In Geneva, this may ultimately turn out to a re-agreement of the re-agreement. But we know that part of what they are trying to achieve here, at least what the Treasury Secretary Scott Bessent has signaled, and is an extension beyond the current trade détente that is set to expire on August 12th, potentially for another 90-day period, which appears to be the time window in which incrementally we are now working through this trade relationship. But we know it's going to focus, as previous talks have, on some critical issues, including export controls. On the U.S. side, of course, export controls related to advanced technology and semiconductors, for example. And on the Chinese side, export controls around critical minerals and rare earths, which is a market they have a chokehold on, and easing up the permitting, essentially, or the allowances of U.S. companies to purchase those critical minerals is what is going to be crucial for moving this forward. Another thing that is on the agenda, we understand, in Sweden is the fentanyl tariffs in particular. That tariff rate, of course, is set at 20%. And while China argues that fentanyl is mostly a U.S. domestic issue, that's somewhere where the U.S. is looking for more movement from China on. So we'll see if we see progress in that arena tomorrow.
All right, Kailey Leinz, you can catch her at the top of the hour as co-host of Bloomberg's Balance of Power. All eyes right now on these trade agreements potentially being struck, the negotiations over there in China. And, of course, a big Fed meeting that kicks off tomorrow where the members of the FOMC are going to have to talk about those tariffs, talk about that August 1st deadline, and talk about whether it matters at all to their monetary policy decision. Vincent Reinhart joins us right now. He's chief economist over at BNY Investments and spent more than 2 decades at the Federal Reserve, including as economist on the FOMC. And Vincent, that is my first question for you, really, is we've heard from Jay Powell in the past press conferences talk about this idea that members are waiting for more clarity when it comes to tariffs before they can really assess the economic impact and as a result assess whatever monetary policy response is needed. Do we have enough clarity, or maybe they can start to have serious discussions about it now?
That's really the key issue, and it is probably going to be underlying 2 dissents that we'll hear about Wednesday afternoon. The main strategy of the FOMC has been what you said: wait until there's evidence that the tariffs have come into place and see how that is reflected in prices and expectations about prices. We haven't gotten all the tariffs yet, and we haven't seen the pass-through of even the tariffs we've gotten. That's why the FOMC is waiting. There are 2 dissenters, however, who want to act on an unconditional forecast. That is, they've got the belief that a tariff is a one-off effect on prices that won't materially affect inflation. Therefore, it wouldn't be the most surprising thing in the world to see Vice Chair Bauman and Governor Waller dissent.
This gets, though, to the idea. I mean, right now, and we should just make clear for our viewers, no one's expecting a change in rates at the Wednesday decision. We're basically going to stay at that 4.5% range on the upper bound. But once you start to get into September meeting and into, of course, the October and December meetings, there has to be a material discussion about moving rates. And I guess my question is, Vince, do you think that that discussion will be more about moving them up or down?
You're right. Bulk of the FOMC participants want to see evidence, and the other part is doing nothing is hard work. In this particular case, they won't do anything on rates, but how they frame their decision will be important for expectations about September. It's most likely that rates are going down, and that's because the Fed has made progress in returning inflation on a trend basis to its goal of 2%. They see tariffs as a detour on that route, but not changing the direction of travel. So rates will probably be headed down. Outstanding guidance is that they'll cut rates in 2025. So if they don't do it in September, they'll probably do it in December.
How much I guess, power do you think Powell is going to have at this stage to really sway market expectations in the direction of where he thinks they should be or where he thinks rates might end up be going, particularly in light of all of the discussion about Fed independence, all of the pressure coming from the White House, and the idea, if you believe Scott Bessent, that maybe in a few weeks' time, we might actually know who the president's preferred Fed chair would be for whenever Jay Powell actually does leave?
Yeah, you're right. Check the calendar. Jay Powell's term is ticking down. And that's got 2 implications. One is he doesn't have as much soft power as the chair normally has to deal with recalcitrant members. It's not like he can promise that he'll give them a bigger platform next year. He won't be around past May. The second part is, I think, why the White House is complaining so much about Jay Powell. They're really signaling what the next chair of the Federal Reserve is going to be like, one more accommodating to lower interest rates. And that next chair matters for medium and longer term interest rates. So Chair Powell will matter for the effective federal funds rate until May, but beyond that, it's the next chair.
It's the next chair, and it gets to the question, Vince, in your view, when you look at what the White House wants out of a Fed chair, does that actually adhere to the Fed's mandate? Because I understand fiscally why they would want rates materially lower, but is that going to sort of hew to the Fed's dual mandate?
So that's the real question. And by and large, if you wanted to understand Fed policy over the last 60 years or so, don't listen to what they say. Look at the data. Usually they respond systematically to the data to fulfill their mission. Next Fed chair does that, then he or she is going to be disappointing to the White House, most likely, because inflation's stubborn, the macroeconomy is actually performing well, and someone responsive to the data probably not going to find the reason to cut rates nearly as much as President Trump has talked about.
All right, Vince, always appreciate you taking time for us. Vincent Reinhart, Chief Economist over at BNY Investments. And just a reminder to our viewers, the Fed's two-day meeting kicks off tomorrow morning with the decision and press conference Wednesday afternoon. Stick around. We'll set you up for what to watch over the next 24 hours. This is Bloomberg. Let's set you up for what to watch over the next 24 hours, and it includes earnings, a lot of earnings. Before the bell, UPS, Spotify, Boeing, Royal Caribbean, JetBlue, Stellantis, Norfolk Southern, United Health, PayPal, and Procter & Gamble. And that's just before the market opens. Once the market closes, Starbucks, Visa, Electronic Arts, Caesars, Mondelez, Booking, Avis, Cheesecake Factory set to report after the bell. All of that, of course, could move the market. But in between all of that, we're going to get a read on the macro with the IMF releasing its updated world economic outlook. And at 10 a.m. Eastern time here in the U.S., we're going to get that JOLTS data, sort of the drumbeat to Friday's monthly payrolls data. That JOLTS data also going to come along with an update on consumer confidence. And, of course, the Fed kicking off its two-day meeting at the renovated headquarters there in Washington. That does it for us here on The Close. Balance of Power's up next.